Many a times it is seen that people tend to know the difference between fixed assets and current assets intuitively. However, the exact points of differences are not always clear. In this video, we will learn the underlying principles that differentiates fixed assets from current assets. The two basic features of fixed assets are these are meant for long-term use in the business enterprise. And number two, these are not meant for resale. These are acquired for using in the business for producing other goods and services and thereby help in income generation. So we can see that fixed assets is meant to be used for several years in a business for increasing the profit earning capacity, and these are not meant for resale. These are used for generation of revenue. For example, if a person purchases a new house, then rent can be earned from the same over a very long period of time. The house has been purchased to earn income for several years. So we can see that if a person has purchased this house, then on year 1, year 2, year 3, year 4, year 5 and so on, rent can be continuously earned over a very long period of time. The house has been purchased to earn income for several years. The main purpose of buying the house is not to sell it within a short period of time. Of course, the person can sell the house, but the main intention while buying was to earn rent over several years. Similarly, a business unit acquires a factory. So it acquires a factory for producing goods and earn revenue over a very long period of time. The intention is not to sell the factory within a short period of time, but to put the factory into use, to produce goods and services, and every year, year on year, to earn revenue out of it. One point of caution: when we say that fixed assets are not meant for resale, it does not mean that fixed assets are never sold by a business. When fixed assets can no longer produce goods due to prolonged wear and tear, or because due to obsolescence, or because of their continuous use or whatever, the business entities are required to sell fixed assets and they acquire newer ones. What we mean that fixed assets are not meant for resale is that in the normal course of the business, fixed assets are not sold. They are used to produce other goods. Now let us try to gain some insight into current assets. Current assets are those which are either converted into cash within a short period, generally 1 year, or which are meant for resale. Current assets are also termed as floating assets because the value of these assets keeps on changing during a year. So current assets are meant to be converted into cash within a short period of time, unlike fixed assets which are meant to be used in the business over a very long time period. So examples of current assets could be short-term investments. That means if your business advances short-term loan to somebody and the other person will return the money within say 6 months or 7 months, then this investment can be, or this amount which you have given to the other party can be termed as short-term investments, or it is also a current asset. Similarly, inventory, stock or goods are also termed as current assets. These are examples for current assets. In this example, we can see a factory converting raw materials into finished goods or finished products, also known as stocks, goods or inventory. Goods or finished goods produced by a factory are meant to be sold in the market for earning profit. Hence, inventory, finished goods or stocks are identified as current assets because these are meant for resale within a short period of time. The intention of the businessman while producing goods is not to use them in the business for long-term use, but to sell them in the market so that cash can be generated and profit can be earned. Again, the goods or inventory get converted into cash once they are sold and cash is used by the business to produce more goods. Remember, the factory where these goods are produced is considered as a fixed asset. Another major current asset for a business is debtors or accounts receivable. Many businesses sell goods on credit to their customers. These customers who are yet to pay the money to the business against their purchases are referred to as debtors for the business. Although the customers have bought goods from the business on credit, they are expected to make the payment in a short period of time. Hence, debtors are regarded as current assets or floating assets because the amount will be converted into cash within a short period. To conclude our discussion, fixed assets are for long-term use and are not meant for resale, whereas current assets can be converted within a year, can be converted into cash within a year, or these are meant for resale during the year. I hope the differences are clear. Thanks for watching.